Everyone, welcome back to my channel. If you're not new here, you already know that I've been consistently building an undervalued stock portfolio and sharing the whole journey with you here on YouTube. Well, today marks the 14-month update and I wanted to share with you guys where things stand, what's working, what's not, and how the whole portfolio is shaping up. So here's the deal. Starting back on March 1st, 2024, I made it my goal to invest $1,000 every single month into stocks that I believed were undervalued based on real metrics. That's $14,000 invested so far, and today we're going to break down exactly where that money went and how those investments are doing. So in this video, I'll walk you through the investing strategy I've been following, the companies I picked, how they've performed over time, and whether or not this approach is actually beating the market. So first, let's talk about the strategy behind the portfolio. From the start, I wanted to be intentional and focused. No YOLO plays, no hype chasing, just smart investing based on research and long-term thinking. Here's what my approach looks like. First, I'm only investing in companies I actually understand and trust. I am avoiding meme stocks, overly speculative stuff, and anything that just doesn't make long-term sense to me. I want to own companies and businesses that I'll be comfortable holding for years. Second, I'm making sure every company looks undervalued using at least two valuation methods. I'm not just going off my gut feelings, I'm actually using data. Things like price to earnings ratios, discounted cash flow models, and other tools help me confirm that these stocks are trading below what I think they're actually worth. Third, I'm not limiting myself to just value or growth stocks. I'm open to both. So value stocks are usually the companies that are trading at a discount compared to their fair value today. These are often established and steady companies. Growth stocks, on the other hand, might seem expensive right now, but if they grow the way I believe they will, today's price could end up being a bargain. So by staying open to both types, I'm giving myself more chances to find solid opportunities. Fourth, I'm implementing a diversification rule that no single stock should take up more than 15% of the portfolio. This keeps things balanced and lowers the risk if one company underperforms. Fifth, I'm also diversifying across at least 5 different sectors. I don't want to be too exposed to just one industry, so this helps spread the risk and smooth out my returns. Next, I'm trying to keep the overall beta of my portfolio at 1.5 or lower. And finally, I'm focusing on companies that are consistently growing. I'm looking for businesses with at least 5 years of steady revenue or market share growth, ones that have already proven they can execute over time. So this is my strategy and the mindset I'm bringing to this portfolio. Long-term focused, data-driven, and diversified. So now that you know the strategy I'm following, let's talk about what I've been doing most recently. So last month in April, I put another $1,000 to work, just like I've been doing every month. And in this next section, I'll break down exactly which stocks I bought and the reasons behind each pick. First up, I picked up 8 shares of Chipotle at an average cost of $47.19, which came out to a total investment of $377.52. Next, I added 4 shares of Nvidia at $99.35 per share, bringing that investment to $397.40. And lastly, I bought 2 shares of Pulte Group, the real estate builder, at $100.68 per share, which totaled $201.36. So overall, I invested $976.28 in April, so I had $20-something left over in my account for the next month's investments. So why did I buy these companies? Well, like I always do, I calculated the intrinsic value or fair value of each stock based on multiple valuation methods, including things like DCF model, PEG ratios, and earnings projections. For Chipotle, I calculated a fair value of $68.28, which means there was about 44.7% upside from what I paid. For Nvidia, my fair value came out to $126.56, giving it a 27.4% upside. And for Pulte Group, I estimated a fair value of $148.12, which translates to a 47.1% upside. So I bought all 3 companies as a long-term investment, trying to benefit from these stocks selling at a discount now. And now let's take a look at where those prices stand today in May after a month so far. Chipotle is currently trading at $49.72, which puts me at a 5.4% gain so far. Nvidia is at $116.65, giving me a solid 17.4% gain. And Pulte Group is sitting at $102.47, which puts me at about 1.8% return so far. So these are the 3 stocks I invested in last month, and that's how they've performed so far. Now let's zoom out and take a look at all the stocks I've picked up throughout the last 14 months of building this portfolio. So with my investments over the past 14 months, I've now built a portfolio of 24 companies that I believed were undervalued at the time I bought them. Let's quickly walk through each company I currently own alphabetically, and I'll highlight a few that I managed to grab at what I think were great prices. You can also see all of my average buy prices in the table on the left, or visualized on the bar chart. So first up is Adobe, which I'm holding at an average cost of $461.36, quite expensive compared to its current price. But this is a top-tier software company behind popular tools like Photoshop. Then there's Alibaba, the Chinese e-commerce giant, which I'm holding at $72.45 per share, definitely one of the steepest discounts I've managed to catch. Alphabet, the parent company of Google, is next at $165.91, and it was an obvious long-term pick with its dominance in search and cloud. Apple comes in at $173.21 per share, again one of those foundational tech stocks I'm confident in, and I'm personally a customer of a lot of their products. Then we have Baidu, the Google of China, at $85.53, and Boeing, which I bought at $172.39 to give me exposure to aerospace and defense. I also own shares of BYD Company, a strong EV play out of China, at $57.75 per share. Chewy, which I got at $16.84, is my play in the pet care sector, and Chipotle, which I now own 20.5 shares of, came in at an average cost of $48.37. Costco was a small but strategic buy. I grabbed 0.25 shares at $721.16. I'm a huge Costco fan and a member myself, so this one was more personal. I also picked up Disney at $97.97, seeing potential in its content and brand power despite short-term challenges. Estée Lauder at $68.59 gave me some exposure to global cosmetics, and Lyft was an amazing value play at just $9.76 per share. On the fintech side, I added both MasterCard at $445.10 and Visa at $268.88, two of the strongest names in payments. McDonald's is in the portfolio at $285.97 thanks to its consistent performance and global reach, while Microsoft is one of my favorite tech plays, especially in AI and cloud, which I bought at $411.35. Nvidia was one of the most hyped stocks of 2024, and I managed to get in at $108.86, which I'm very happy about. PayPal, which I got at $60.93, still looks beaten down but has long-term upside. Pulte Group at $106.93 gives me real estate exposure, and Shopify at $62.29 adds e-commerce growth to the mix. Target at $137.81 has been a reliable retail pick despite its short-term challenges, and Tesla, which I got at $172.22, adds more EV exposure alongside BYD. Rounding it out, I added Unilever, a strong global consumer goods company, at $49.66, and Visa again, which strengthens my position in digital payments. So with this diverse mix of undervalued companies, I'm positioning my portfolio to capture both growth and value across different sectors. Now that you know which companies I'm holding, let's move on and take a look at how diversified this portfolio really is. As I mentioned earlier, I've followed a strict rule throughout this journey. No single stock should make up more than 15% of my total portfolio. This has helped me minimize risk and avoid becoming too dependent on any one company, no matter how promising it may seem. Now, after building out this undervalued portfolio across 24 companies, I've achieved a fairly balanced distribution across my positions. Boeing currently holds the largest slice of my portfolio at 10.9%, giving me some strong exposure to the aerospace and defense sectors. Shopify and Nvidia are next, each representing 8% of the portfolio, both high conviction plays in the tech and e-commerce spaces. Alphabet also holds a sizable share at 7.3%, as does Pulte Group at 7%, giving me some solid real estate exposure. Disney makes up 6.6% of the portfolio, and while the company has seen its ups and downs recently, I'm confident in the long-term value of its content and brand. Other notable positions include Chipotle at 6.3%, Adobe at 6%, Chewy at 5.7%, and Lyft at 5.2%. And then there's the smaller end of the portfolio. These are the companies that currently make up less than 2% of the total. Alibaba at 1.6%, BYD company at 1.2%, Costco at 1.6%, McDonald's at 1.1%, PayPal at 0.9%, and Unilever at 1.2%. And while these positions are relatively small, many of them were strategic buys at a discount or early entries into longer-term plays. In terms of dollar investment, the average amount I've put into each stock is about $669, with a median of $598. My largest single position is worth $1,754, and the smallest is at $141, which shows that while I've kept the portfolio balanced, I've also let some of my best performers grow naturally over time. This structure helps me manage risk while also giving me some room for upside where I see long-term potential. Next, let's look at how I've spread these companies across different sectors and how that's helped me round out the overall strength of the portfolio. So diversification isn't just about spreading investments across different companies. It's also about avoiding overexposure to any one sector. For example, I could have gone all in on tech stocks, but if the tech sector takes a hit, my entire portfolio would be at risk. That's why I've been intentional about allocating my investments across a range of industries. Let's walk through how that breakdown looks today. Technology leads the way, making up 30.8% of my portfolio. This includes heavy hitters like Adobe, Microsoft, Nvidia, and Alphabet, companies that are not only market leaders, but also continue to push the boundaries of innovation. I'm comfortable with this larger allocation given the long-term upside of the sector, but I'm also watching it closely to make sure it doesn't throw off the portfolio's balance. Then transportation comes in second at 21.1%, driven by my positions in Tesla, Boeing, Lyft, and BYD company. This sector gives me exposure to electric vehicles, ride-sharing, and airspace, all of which I believe have solid growth trajectories over the next decade. E-commerce is another big component at 15.2%, with companies like Shopify, Chewy, and Alibaba leading the way. These stocks had their fair share of volatility over the past year, but that volatility gave me some great entry points. I see very strong upside potential here as online shopping continues to expand globally. Next, restaurants now make up 7.4% of the portfolio, thanks to Chipotle and McDonald's. Both are strong, recognizable brands that have managed to grow despite inflation and shifting consumer habits. Meanwhile, real estate represents 7% through my investment in Pulte Group, which gives me exposure to the housing market and home building. Retail accounts for 6.9%, supported by names like Costco and Target. Entertainment comes in at 6.6%, largely through Disney, which I believe still has significant long-term value through its franchises and theme parks, even as streaming evolves. Finally, financials round things at 4.9%, anchored by MasterCard, Visa, and PayPal. These are two giants in digital payments and, in my view, essential infrastructure for the global economy. While this sector is a smaller piece of the pie, I like its stability and long-term relevance. Overall, this current industry mix gives me confidence that I've built something durable thus far. I'm exposed to growth sectors, but I've also got some defensive plays in there too. And coming up next, we'll explore a key risk metric called beta and how my individual stocks and the portfolio as a whole stack up in terms of volatility. So in simple terms, beta is a measure of how much a stock moves relative to the overall stock market. A beta of 1 means the stock typically moves in line with the market. If the market goes up, the stock with a beta of 1 is expected to rise by a similar amount, and vice versa. A beta higher than 1 means the stock tends to be more volatile, swinging more dramatically than the overall market. On the other hand, a beta below 1 suggests the stock is less volatile, generally moving more steadily. And for my undervalued portfolio overall, the weighted average beta is 1.49, which means it's a bit more volatile than the overall market. If you guys remember from my strategy section earlier, my strategy is to keep my beta at around or less than 1.5, so I'm right at that number now. Now let's take a quick look at a few extremes on both ends of the spectrum. On the higher end, the most volatile stocks in my portfolio are Shopify with 2.67, Tesla 2.43, Lyft 2.14, and Nvidia at 2.11. These companies operate in fast-moving industries like e-commerce, EVs, and ride-sharing, where innovation and market sentiment can cause rapid price swings. And I'm okay with the extra volatility here because I see strong upside potential over time. And on the lower end, we've got BYD company at 0.10, Baidu at 0.37, and Unilever at 0.44, all of which are international companies and tend to move more steadily. Their low beta scores suggest that they are less tied to the day-to-day moves in the US market, which gives me some built-in diversification. These positions with a lower beta act as a buffer against volatility in more aggressive parts of my portfolio. So overall, while my portfolio leans towards higher beta, higher growth names, I've also made room for some more stable, low beta holdings. This mix gives me the potential for strong returns while helping to reduce total portfolio risk when markets get choppy. Up next, let's break down how my investments have actually performed after 14 months. My wins, my losses, and everything in between. Let's start with some of the best performers in my portfolio. Chewy is still the top standout of my portfolio, delivering a 135% return so far. My $387 investment more than doubled, growing to $910, resulting in a $523 profit. The pet care industry continues to grow, and Chewy's position as a market leader has clearly paid off. Shopify also had a fantastic year for me, rising 47.3%. My $872 investment is now worth $1,285, giving me a solid $413 gain. Shopify's continuous push to empower e-commerce businesses globally is showing real staying power. Tesla increased by 73.2%, turning my $344 investment into $597 for a $252 gain. And as EV adoption continues to accelerate worldwide, Tesla's momentum continues to reward early believers. And BYD company actually matched that growth exactly at 73.2% as well, with an $85 profit on a $116 investment for me. As a global EV competitor to Tesla, BYD is becoming a major player in the clean energy space. Other strong performers in my portfolio include Lyft up 70.6%, Alibaba up 73%, and Costco up 40.6%, each contributing nicely to my overall returns. And on the flip side, a few stocks posted losses so far. Adobe is currently the biggest drag, down 16.9%, resulting in a $195 loss. While disappointing in the short term, I still believe Adobe's leadership in creative software positions it well for future growth. Next, Target declined by 29%, dropping $120 on a $413 investment. Retail has faced a lot of headwinds, but I'm watching this one closely to see if it can bounce back. Estée Lauder is down 10.1%, and Alphabet slipped 7.8%. These aren't major losses, and given their strong brands and global reach, I'm comfortable continuing to hold. Pulte Group saw a modest decline of 4%, likely tied to fluctuations in the housing market. So overall, the portfolio shows a lot of green, with strong double-digit returns in multiple different positions. And despite a few current losses, the overall trajectory supports my focus on undervalued opportunities with long-term growth potential. And coming up next, we'll break down the total portfolio performance and see how it all adds up after 14 months. So how has my entire portfolio performed after 14 months? Let's break it all down. With a total investment of $14,000, the current value of my portfolio has grown to $16,056, representing a 14.7% return on investment or ROI. While this is a bit lower than last month's ROI due to some market shifts including tariffs, it's still a strong overall gain that reinforces the value of my long-term, fundamental-driven strategy focused on undervalued stocks. Looking at the details, 19 of the stocks in my portfolio are showing gains. Leading the way once again is Chewy, which delivered a remarkable 135% return and added $523 in profit. On the flip side, 5 stocks are currently in the red. The largest percentage drop came from Target, which is down 29%, while Adobe saw the biggest dollar loss at $195 so far. And although these losses are not ideal, they remain manageable and are far outweighed by gains elsewhere. So to put things in perspective, if I had simply placed the same $14,000 in a cash savings account, I'd still have exactly $14,000, no gains at all. If I had instead invested in the S&P 500 over the same period, I'd have $14,459 today, representing a modest 3.3% return. In contrast, my undervalued portfolio not only outperformed cash by over $2,000, but also beat the S&P 500 by nearly $1,600. This performance so far shows that my focus on identifying high-quality undervalued companies with long-term upside potential is continuing to pay off. So in summary, despite a few underperforming stocks, my portfolio has delivered a healthy 14.7% return, fueled by big wins from companies like Chewy, Tesla, and Shopify.